They warned you it would collapse. They said Friday marked the peak. They told you to take profits and walk away. But when the market opened this Monday morning, it delivered its response. And that response was a strong green candle that erased the bearish argument in just 1 hour. Look at the screen. Silver is trading at $69.14. Earlier today, it reached $69.40. That's a move of nearly $2 since the open. That's close to a 3% gain in a single trading session. This kind of move is not normal. Commodities do not usually rise 3% on a Monday morning unless a major global event is unfolding. What we are seeing is not a normal trade. This is a liquidation. The banks that went short on Friday are now stuck. They are underwater, and they are doing the only thing left to protect themselves. They are buying in panic. They are slamming the buy button, trying to close their positions before silver touches $70 because they understand what that level means. They know that $70 is the line that changes everything. Once $70 breaks, automated systems take over. Price enters a vacuum, and the next destination becomes $75. In this urgent market update, we are breaking down what happened to the shorts on Monday. We are examining the volume behind this move to see if it is legitimate, and we are focusing on the psychological importance of $70. We are inches away, and the banks are clearly nervous about what happens next. This is the day suppression stopped working. To understand how aggressive this move is, we need to rewind to Sunday night when Asian markets opened. There was no hesitation, no dip, no test of support. There was only a gap higher. Price jumped immediately and then followed a very specific pattern known to technical traders as a gap and go. Normally, when price gaps higher, it pulls back to fill the gap. It revisits the prior close. That did not happen today. Price opened strong and continued climbing. That signals urgency. It means buyers were unwilling to wait. They were not negotiating over small price differences. They wanted exposure immediately. Retail traders usually wait for pullbacks. Hedge funds use limit orders. The only buyers who act this aggressively are forced buyers. That means margin calls. It means traders who were told by their broker, close this position now or we will do it for you. This confirms what we suspected over the weekend. The margin calls were real. Banks spent the last 48 hours calculating their losses from Friday, and this morning they shut down their short positions. We are watching forced liquidation unfold in real time, funded by the banks themselves. Now let's talk about the high of the day, $69.40. Why did price pause there? Why didn't it immediately break $70? Because $70 is a major psychological barrier. Traders call this a big figure. People naturally take profits near round numbers. As silver approached $69.50, short-term traders began selling to lock in gains. But here's the bullish signal. Price did not fall back to $67. It only pulled back slightly to $69.14, and it held. We are now hovering just below resistance. In technical terms, this is called pressure building. The price is not retreating, it is waiting. Each sell order near $69 is being absorbed by a buyer. Eventually, there are no sellers left at $69.99, and when that happens, price moves instantly to $70.10. Now picture what is happening inside a major New York bullion bank. You are responsible for managing the short exposure. Your firm sold millions of ounces of paper silver. On Friday, you thought $65 was enough to stop the rally. Now silver is trading near $69. That's a $4 loss per ounce on millions of ounces. Your profit and loss screen is bleeding red. Your risk manager is standing behind you, demanding action. You can't add more shorts. Risk limits are already maxed out. So you cover. You buy back what you sold. But every contract you buy pushes the price higher. You buy 500 contracts, Price jumps to $69.50. Another bank panics and buys, pushing price to $69.60. This creates a feedback loop that destroys shorts. They are trapped, and the exit keeps shrinking. That's why this rally feels unstoppable. It isn't driven by excitement, it's driven by fear. Now look at the financial headlines. Is silver surges to $69 the top story? Probably not. They're focused on stocks, interest rates, and tech earnings. Why? Because rising silver prices expose inflation. They signal weakening confidence in the dollar, and they show that managed money is losing control. The lack of coverage is actually bullish. It means this move is still under the radar. The general public hasn't joined yet. Your family isn't asking about silver. Your Uber driver isn't talking about it. This rally is being driven by institutions and forced buying. When the media finally catches on, that's when the next wave begins. And if silver is already at $69 without public participation, imagine where it goes once the crowd arrives. Now let's address the timing. It's late December. Holiday trading has begun. Senior traders are leaving their desks. Volume is thinning. Normally, low volume means calm markets, but during a squeeze, low volume means danger. It creates a liquidity trap. If sellers are gone and a large buy order hits, price can jump $5 in minutes. In Part 2, we explained why the holiday period may be the most volatile time of the year. Thin order books favor buyers. If $70 breaks during low liquidity, price may jump straight to $75. The banks are hoping for a quiet holiday. They won't get it. As of now, it is Monday, December 22nd. Silver is trading at $69.14. Friday's drop has been erased. The $67 resistance has been broken, and $70 is directly ahead. Only one variable matters now: the calendar. It is 3 days before Christmas. Usually, this is when markets go quiet, but not this year. This rally during the slowest week of the year is a warning sign for the banks. Low liquidity does not mean low volatility. It means the opposite. The desks are being run by skeleton crews, junior traders with limited authority, and when risk spikes, they don't fight it, they cover. That accelerates the move. Now add options gamma to the mix. There was a large call option wall at $70. Market makers sold those calls. As price approaches $69.40, they must hedge by buying futures. In a thin market, that buying moves price higher, forcing more hedging. This loop can trigger explosive upside moves. Silver could hit $72 in minutes under these conditions.
Meanwhile, the physical market is nearly closed. Mints and refineries are shut down for maintenance. No new supply is entering the system. But demand continues online. Retail buyers are active. Industrial buyers are placing orders. By January, inventories could be drained. That's why premiums remain high, even as spot rises. Dealers can't restock until mid-January. Demand is pulling forward into the weakest liquidity window of the year. Everything leads back to $70. In Part 3, we examined why $70 is a long-term resistance level and why breaking it changes everything. Once silver enters unexplored price territory, there is no historical resistance. There are no trapped sellers waiting overhead. That's called blue sky. Momentum takes over. Now we reach Part 4. The market closed with silver holding $69.14. The banks failed to break the market on Friday. They failed to scare holders out, and on a quiet Monday, silver rose nearly 3%. That is a statement. Now the challenge is holding. It's easy to hold when prices fall. It's hard to hold when you're winning. That's why strategy matters. 2 levels define everything. $70 is resistance. A daily close above it confirms breakout. $67 is support. As long as price stays above it, the trend remains intact. Avoid leverage. Holiday volatility destroys leveraged traders. Physical silver has no margin call. It simply exists. Low volume does not mean weakness. It means fewer sellers. We have broken multi-year consolidation. We have crossed major psychological levels. We're in the recognition phase, not the peak. Silver at $69 feels high only when compared to $20. Compared to industrial demand, mining costs, and monetary expansion, it remains undervalued. So watch $70. Respect volatility. Ignore noise. The banks lost control today. You waited, you held. Now enjoy the moment. The Monday massacre belonged to the bulls. Let's see what Tuesday brings. Subscribe.